Okay. Good evening, everyone. Thank you for joining us tonight. For those of you that do not know me, my name is Lisa Partida, and I work with Family Promise of the Verdugos, and I'm also the case manager for the Lifting People Up program for BHC residents. And tonight, Brock will be speaking to us about first-time home buying, and that's obviously a topic that interests a lot of us. And yeah, so if you guys have any questions, please wait till the very end, and you guys can go ahead and ask then. All right, so Brock, you can go ahead.
Thank you, Lisa. My name is Brock Collins. I'm the Director of Business Development for Gain Federal Credit Union. And I'll just read a quick disclaimer here before we get started. And that is, this is not intended as legal advice. Materials were prepared by Gain Federal Credit Union staff. Although this presentation was prepared with care, it is not designed to be a complete analysis. Moreover, this presentation was prepared with the understanding that it reflects the author's perception of the materials as of this date. In an effort to comply with IRS regulations, we inform you that any tax advice in this communication is not intended to or written to be used, and it cannot be used for the purpose of avoiding penalties under the Internal Revenue Tax Code or promoting, marketing, or recommending to another party any transaction or matter addressed herein. If you have any specific questions regarding your personal situation, please contact your attorney or tax professional for additional assistance. Okay, and then just a little bit about Gain, so I can share about my institution that I work with. We are a credit union, and our promise, as you can see, is to share our knowledge to for your financial advantage. I usually say share our knowledge for your financial gain, and our statement is better banking, right? So some of the differences between your typical big bank and your credit union is, number one, we're not for profit, right? We're not a giant for-profit machine here that's churning out millions and billions of dollars in profit a year like some of the larger institutions. Therefore, we don't have shareholders. We're not trying to gouge our members with fees and high cost loans and things like that. We're not trying to keep generating income, which we pass off to people that take ownership in the company. You're technically a member, not a customer. So when you join a credit union, you have a little bit more of a voice. It's considered a cooperative, and you technically, you can go to our annual meeting. You can ask our board questions. You can actually contact our CEO. It's a little bit difficult to do with some of the other institutions that I've been a part of. And then again, the great thing is our board of directors, they're all local volunteers. So essentially what's in their best interest is probably in your best interest, right? They're not getting paid to hold those seats, and they're making and driving decisions for the credit union that are better for the community. And then last question I get a lot is, are you federally insured? And we're federally insured by the NCUA versus the FDIC. Both are large organizations, national organizations. The main difference is because we're not for profit, at the end of the year, every credit union needs to send a portion of their income over to the NCUA, which will fund any struggling credit unions there, versus the FDIC is actually funded by you and I as taxpayers, right? But the same limits, the $250,000 still applies there. And then our statement of belief, Gain is a progressive financial institution that believes everyone deserves access to fair and honest banking services. And we're the trusted neighborhood partner that supports the financial health and well-being of our members. And with that, we've done a host of seminars. We just finished April, which was Financial Literacy Month for us. And we hosted topics on anything with realtors to financial advisors, the state of the market with COVID. We're doing home buying tonight. And so we're really always trying to just spread free financial knowledge so people make better decisions in their everyday lives. So about me, I'm the Director of Business Development here. As you can see, the other individual, Sharon Wilson, is not with us tonight. She is our real estate lending manager, but I did want her to be on this slide as usual. So you have her email address and phone number. So if you are looking for a free consultation, if you are looking to get specifics with percentages, numbers based on your scenario, your income, anything like that, Sharon is a fantastic resource. Feel free to reach out to me also. My contact information is down below, my email and my phone number and extension. But Sharon is the one that's processing these and seeing these every day. Doesn't cost you anything. You can reach out with any question. We're here to guide you along this process, right? Buying a home is very difficult. It's very stressful, and we want to make it as easy as possible for you to make these decisions and understand what you're getting involved with, right? So some of the objectives tonight, what does the home buying process look like? Who helps guide me through this journey? What's the difference of a pre-approval versus a pre-qualification? What documentation is required, because there's a lot of documentation that your lender is going to ask for. Budget, credit scores, different types of loan products. We'll discuss 2 of those. And then realtors, finding a property, what does the process look like? And a lot of other little tidbits that you'll have to consider along the way. So when you first start out and you're looking for a home, congratulations for getting to that point, because that's a commitment in its of itself. You want to analyze your needs versus wants, right? We all may want that golden palace that has 10 bedrooms, 10 bathrooms, and sits on the hill overlooking Burbank. However, we all know how expensive that would be, right? So what do you need versus what do you want? We want to get a pre-approval from a loan officer, and I'll talk about that in another slide or 2. We want to consult with a local realtor that knows the market that you're buying in, because sometimes there's little intricacies that vary from city to city. You're going to view the property, which is a little different in COVID times. Some people are literally doing a Zoom and walking through the property, or doing a live video and looking at it versus physically being present. Select a property, submit an offer, going to put what they call earnest money or deposit money down. You're going to finalize or remove the loan applications, removing contingencies, get insurance, title search, all that stuff will be done by third parties, and then sign documents and move in. Sounds pretty easy, right? All right, so some of the major players that you'll be working with along this journey. Obviously, there's a buyer and a seller, right? They're moving the home. Then there's a real estate agent who hopefully is guiding. Sometimes there's 2, sometimes there's one that represents the seller, one that represents the buyer. The real estate agent, just so you know, is paid. They make their money from the seller of the property. So whoever is selling the property is in charge of paying the standard 6% or so. Sometimes it's 5 to 6% to the agents, which they then split. The loan officer, who's going to work with your financial institution and be the ones that fund the mortgage. You're going to have an underwriter that's technically looking at the overall package. They're going to be looking at your credit scores, your debt to income ratios, asking for pay stubs, things like that. And they're going to make the decision on whether the institution is going to give you that loan. Escrow, which is a third party, a neutral party, is going to be handling all the documentation back and forth from the 2 sides. We want a neutral party in the middle there that'll handle these large dollar amounts. Title, these guys are going to make sure that everything is free and clear on the home. You don't want other people having legal, hold of your home while you're living there or purchasing it, right? So you don't want any liens on the property, things like that. Home inspectors, and again, miscellaneous inspections or anything extra that you wanted inspected. So if you want a specific expert on plumbing or electrical or some system in the house, you would bring them in to inspect that. Okay, so the pre-approval and pre-qualification. And just to let everybody know, nowadays, every realtor that wants to work with you, wants to be serious, wants you to be serious, and they're going to ask for a pre-approval up front. Right? A pre-qualification, which was used more in the years past, was basically a lender giving you a letter saying you're pre-qualified based off the information that you've provided the lender. Now that doesn't mean that they've seen your credit score, for instance. That doesn't mean that they've seen your pay stubs to verify, for instance. So a pre-qualification is almost, I don't want to say it's worthless, but it doesn't help you in today's environment where properties are moving very quickly. The sellers want to see that you're serious and that you actually have the backing of a financial institution so you can get that loan. So that's why it's very important to have a pre-approval before you go out there and you go shopping for real. And then what type of documentation is required? And really these are the basics, and sometimes there'll be more. but they're going to want 2 years of W-2s, right? So this is anybody that's an employee out there. It's not a sole proprietor running your own business. They're going to want to see 2 years of your W-2s. They're going to want to see the last 30 days of payments or a pay stub. So if you're paid once a month, they'll probably just see one. If you're paid every week, it'll be two. 2 months of bank statements to verify assets and down payment of funds. 2 years federal income tax returns. They're going to want to see the last two tax returns that you filed. And then again, if the down payment is coming as a grant, as a gift, as anything like that, they want to see a gift letter from whoever is gifting you those funds. The big caution there, do not apply for credit during this process. So as soon as you apply for the home loan, I know it's tempting, but do not go and buy that brand new car so you can park it in that garage, right? Because that will throw you off the process. Because as soon as you buy that, all those numbers change when that underwriter is looking at your file, the debt to income, and your monthly payments and things like that. So I would suggest checking your credit probably 3 to 6 months out before you're really going shopping. Everybody's entitled to check their credit for free at annualcreditreport.com, and you're allowed to check it, and it will not hit your credit score there. So please take advantage of that. That's annualcreditreport.com. And again, don't apply for credit throughout this process. So some of the considerations that you're going to want to take here, talk to a lender. They're going to help you determine what you can afford. How much do you want to spend versus how much you can afford are usually two different things. So a lot of the loans that are out there have criteria. They will go up to X dollars, right? X percentage of your income. So just because that loan will lend you that 100% amount doesn't mean necessarily that you want to take advantage of it, because there's a lot of additional costs that come with home ownership, as well as you may have additional costs that aren't being factored into that, right? Child care or certain things like that. So we want to sit down and we want to get to a reasonable number that you can afford so that you're not stressing about that payment. And then how much money do you have or need? So the down payment, the smallest down payment that's out there today, well, I should say there's a 0% down in a VA loan, but the typical one is about 3% for an FHA. And then you have closing costs, which can be 1% or 2% above that as well. So it just depends on what type of loan you're taking advantage of. So some considerations when you buy a home, a lot of people look at the monthly payment, the principal, interest, taxes, and insurance, and they say, wow, that's great. That's it. That's everything. Well, these are additional costs that come with that home, right? Home repairs, cleaning. There's a lot of maintenance that comes with keeping it up. Do you have a lot of plants that need to be trimmed every year? Do you have trees that need to be cut? Does paint need to be done on this home? Things like that. So what they typically tell the average home buyer is to budget anywhere from 1 to 4% of the home price. And that should be saved every year, whether that's broken down monthly or annually, and put back into the home. So if you're looking at a $500,000 townhome or something somewhere around here, you're going to want to set aside at least $5,000 a year, up to 20, depending on how old the property is and what shape it is, to put back into that property every year. Essentially, that's just typical maintenance. Something to consider, because this is a big one here in Los Angeles, and Los Angeles County and Burbank and this surrounding area, is where do I get my down payment? Now you can sit there and you can save and save and save, borrower's own funds, retirement accounts, right? There's such things as 401k loans. You can pull out with no taxes or penalty the principal amount that you put into a Roth IRA, things like that. Those are all retirement accounts. Employer assistance, if your employer has a grant program that they give to employees. Again, personal gifts from family or friends. Anticipated sale proceeds means you own one home and you're selling that to move into another one. And of course, donated gifts or grants from the state, things like that. So there's a whole slew of resources out there to come up with a down payment. And then this is just an example that I wanted to throw out there for everybody. And what I wanted to emphasize here was the importance of good credit. So I would say, 8 to 10 years ago, you would typically get what they called the best interest rate on your home loan with a 720 credit score and above, right? 720. Nowadays, the average credit score in America has gone up. So now they're looking at everybody that has a 740 and above. It doesn't mean if you have less than a 740, you can't qualify for a home, but that's typically where most lenders are going to give their best interest rate. So this is an example. We took a median sales price home in Los Angeles of 602, 100,000. So we figured a purchase price of 600,000, 20% down on the home. So the loan amount comes to 480,000. You can see in the chart below, based on your credit score, the difference in interest rate in the second column, the difference in the monthly payment, and the additional interest spent in that last column on the right. So if you're in that 620 to 639 range, over a 30-year fixed, you're going to end up spending over $75,000 in interest alone, right? So we don't want you to spend that extra money. Financial institutions love that, but we don't want you to be in that that category where you're wasting money. We want you to keep that in your pocket. So what type of loan options are out there? Well, there's tons of them. I'm just going to go over a quick one or two. There's fixed rate, which means your payment is fixed for that term. And that term means the amount of time. So there's a 10-year, 15-year, 20-year, and 30-year. The 30-year fixed is pretty much the standard out there. And then there's adjustable rate mortgages. And what this is usually they're fixed for a certain portion of time, and then they adjust so often. So a lot of times when you go into your bank or your financial institution, you'll see something that has a 5, a slash, and then a 1. Well, that means it's fixed for the first 5 years, whatever the interest rate is that's guaranteed. And then every year thereafter, it can adjust. And it can adjust up or down, and there's caps and structure to that, and maximum amounts that they can charge you. So those are the differences there. And then, of course, when you start talking about lower down payments and things like that, there's FHA, which is great for first-time home buyers, has slightly lower down payment requirements as well as slightly lower credit requirements. VA loan for anybody that's a veteran out there, as I mentioned, that's a 0% down. And then there's other government insured loans out there as well. The tidbit there in red with the FHA loan is that if you put less than 20% down on that home with an FHA loan, they're going to charge you what they call mortgage insurance. Now, this is an extra payment that you pay monthly. And what this does is this pays for insurance in case you default on the loan that pays the lender back. So this is why we encourage people to put as much as they can down, because you don't want to be paying for insurance for the institution. It doesn't benefit you. But if that's the way you can get in the home, then great, because we all know that home ownership is a wealth generator, right? It's probably the #1 wealth creator in this country. And with that, you'd have to refinance or sell the property to get rid of the mortgage insurance. It used to be that once you hit 20% equity, you could have it appraised and they'd pull it off. Well, they don't do that anymore. And that's one of the neat things about the VA loan with the 0 down. To thank you for your service to our country, there's actually no mortgage insurance required with that one. So at Gain here, we do all of them. We do FHA, we do VA, and we do what they call conventional, which is the standard, and high balance. We do all of that. So then some people ask me, why would you do an adjustable rate mortgage over a fixed mortgage, so a 30-year fixed? Well, so the next 2 slides are an example of that. And you have a purchase price, a 3% down payment, a loan amount. So this is a typical FHA, right? So this is a 30-year fixed at a 3.5% interest rate. And these were actual rates taken as of August 7th, 2019. So for a 30-year fix, that rate was 3.5%, right? So you see the principal and interest, property taxes, insurance, and then of course that mortgage insurance, which covers the lender. So that total monthly payment came out to $27.25.92 versus a 5-5 ARM, which means it is fixed for the first 5 years, it adjusts, and then it's fixed for another 5 years. In the same terms, 437 purchase price, 3% down. So you have the principal and interest, taxes, insurance, mortgage insurance, and your actual housing payment is $25.81.15. So there's an actual monthly savings of $144.77. So this is an example that an adjustable rate mortgage might actually benefit you depending on what you can do. So if you can take that $144 and you can pay that to the principal to pay it off quicker, or if you can take that money and you can invest it and make more, it just gives you a little bit more flexibility. And some people like that. Now, once we start shopping, how do we find a realtor? Ask for referrals, obviously, right? Friends, family, coworkers. A lot of people know a lot of great realtors. Interview a few of them. So what service do they provide? Do you feel comfortable with them? Do you click with them? How many homes have they sold? Are they new to this job? Have they done hundreds of them? Are there reviews, things like that? And so a little stat at the bottom, 78% of recent home buyers found their real estate agent to be very useful information source. And then, so this is from realtors, and this is kind of a discussion that you'll have with them probably when you sit down, and they talk about what are the deal breakers, right? So what can you compromise in that home? Because we all are in a very expensive market here. Do you need that third bedroom? Is that a luxury to have? Do you need that, that third bathroom, or is that a luxury to have? What type of amenities do you really need versus want? Location is a huge one. Obviously, schools are a huge one. People come to Burbank here because of the schools. We have a great school system. So did you want to stay in this area because of that? Are you planning on this being your starter home or your forever home? If this is your first home, chances are you're more than likely going to move, right? So this could be considered your starter home. And a lot of people want to find that first home and stay in it forever. There's no guarantee. And then again, are you willing to get your hands dirty? It just really speaks to, did you want to do renovations yourself, or are you going to hire somebody to do it for you? So after an offer is made on a home and the acceptance, what happens at that point? So obviously the seller and the buyer, the two parties, they open escrow, which is the third party that's going to handle all the transactions between them. So everything's fair. You advise your lender that you've accepted an offer. You're going to get them what they call a purchase agreement. You're going to start scheduling in your inspections immediately, right? Because what happens is when you agree to buy a home, you agree typically with contingencies. And contingencies mean I'm going to do this, this, and this, right? I'm going to inspect the home. I'm going to look at this. I'm going to make sure I qualify for the loan before I sign on the dotted line. So if you're buying a home, you want to get all those things lined up and the inspections done so you can remove the contingencies and move the process along as quickly as possible. Because the typical escrow process, just so you're aware, is anywhere between 30 to 45 days. So it's not a quick one as this whole stressful thing is going on, right? Title search is going to be ordered by escrow. Lender's going to order appraisal. You're going to start getting insurance quotes for the property. And then you're going to get final approval, sign, get the keys, and live happily ever after. So home inspections. This is just to illustrate that one big circle up there, 86% of homes found something needed to be fixed. So some things should scare you, right? There are some foundation issues. There are some issues that should scare you about buying a home when the inspector finds things. But just so you're aware, a home inspection is typically anywhere from 20 to 70 pages. It can be huge. and they're going to point out every little thing, like this light socket didn't work, or there's this torn on the crown molding. So there's going to be lots of little things on there. So you just have to decide what you're willing to live with and what needs to be repaired, right? Because it's all negotiable. You can ask the seller to repair something or discount that off the price. And then I wanted to leave you with some resources just besides Sharon as well. So I mentioned Sharon earlier as our real estate lending manager. Lisa Donaldson has had over 20 years experience as well here. She's the loan processor. So this is their phone number, their email, their extensions, and you'll see my contact information again on the next slide. I'll give everybody another moment to write this down. All right, that's my contact information. If you do have a question, again, I'm here as a resource as well. And then let's see if we have some questions here. And Lisa, did you want to ask the questions or?
Yeah, I actually don't have any questions just yet. But if anybody does have any questions, you guys feel free to unmute yourselves and ask away.
I'll stop the screen share as well.
Okay. I have a question.
Yes.
Hi, Brock, I have a silly question though.
There's no silly questions.
I'm just curious how some people can do it. I'm a single person. Technically, I'm due to retire about 10 years, but I've always dreamed about home ownership anyway. And the scary part about owning a house is the payment if you're on your own. Like you were giving the examples, and some of the payments were like $2,700 a month and $25. My take-home pay barely, adds up to that monthly payment. Is there any other options or any dream busters like that? That's the only thing that always just holds me back, is that my fear is, can I make the house payment? Because I do have a deposit if it comes down to it, but I'm afraid I won't be able to keep up with the house payment.
When you say keep up with the house payment, are you saying it's a large portion of your income, or?
It'd be all my income.
Okay, so when you're applying for a home loan, one of the things that an underwriter is going to look at is what they call your debt to income ratio. Have you heard about this?
Yeah. Oh yeah.
Okay, so they're going to take your gross monthly income, and then they used to do what called a front end back end, right? And it was 2836 or something like that. Well, now they specifically look at the back end ratio. That's pretty much all that lenders want to see. And what that means is they're going to take the PITI, the principal, interest, taxes, and insurance for the home, right? All the costs for the home. And then they're going to take any other monthly obligations you have. So the minimum payment you have on your credit card, any auto loans, student loans, anything else like that, they're going to add that all up, and they're going to divide that by your monthly gross income. And so if your payment exceeds with these other debts a certain number, they're not going to lend to you anyways, right? So if you can qualify for a loan, more than likely you can afford that payment.
Wow.
Now the couple things that I would say to you, Vivian, is a couple things. Make sure you're ready to buy, like really ready. And I mean, having an emergency fund, right? We talk about having a minimum of 3 months set aside. And as a single breadwinner, sometimes it's more. It's 3 to 12 months. So you may want to have 6 months of living expenses set aside. And you may want to calculate what that mortgage payment would look like in those monthly expenses as well, because that's going to give you some peace of mind. So if you do move into that home and you have 6 months backing you up, that's good. That's going to be good. The other thing is, you mentioned that you're retiring in 10 years, right?
That's the goal.
As the goal. Hey, I wish I could retire in 10 years. That's my goal.
If I can still work, I will. But if I can do it in 10 years, I will too.
So I would say that's the bigger thing to me. And that's one of the issues that I'm very passionate about, saving for retirement, right? Everywhere I go, and I teach a lot of these classes and seminars and things, it's about getting people to think of that retirement. What does it look like for you? What are the different sources of income? How much have you saved? And so you want to be socking away as much as possible into your retirement accounts right now, especially if you have 10 years or less, right? Because you're really down the home stretch here and you want to get there, safely, and you want to actually have, if you're getting Social Security and if you've saved for retirement, you want to have multiple streams of income.
Oh,
So I would prioritize your emergency fund, make sure you're putting what you can away for retirement. And at that point, we start looking at the other items for your financial health to make sure that you're ready to buy.
Yeah, it's hard to buy in LA, honestly, because I may be moving to Missouri, which I know all my family lives there. I know the property. So it's really, I like to stay here if possible, but like you said, it's very expensive here. And I don't want to be too far away because I have a little baby godson. And it's like, darn, why is he born now? It's like, now I can't leave.
But the good thing is if you do go to Missouri, think about how many more flights you could afford to come back.
Yeah, really. Yeah, once the COVID thing's over, then I will probably fly. I'll probably just drive like my dad used to do.
Yep.
Yeah.
And a lot of Californians are moving out, unfortunately, out of the state. And it's just cheaper. Sometimes it's a better quality of life. So yeah, I would just say pay attention to the overall financial picture.
Yes. And I am getting down with my debt, thank God. And I'm finally caught up with my back taxes, and school loan may be gone. We're not sure yet, but yeah, I am focusing on the retirement part, but I just want to take the opportunity to see what Gaines has to offer in terms of, teaching us more things about home ownership.
We have a ton of things. I mean, so the month of April, which was financial literacy, we did ROI versus investment. So what types of items to fix up around your house? We had a realtor present. We had investor advisors presenting investing in a time of COVID. We had all sorts of financial topics. So
thank you. That's a really good thing to know.
I guess Armin has a question.
Yes, I have two questions. So the first one, have you heard about something that Joe Biden is giving for the first home buyers? Like, is it going to be a loan? I heard like people talking, is it true or is it something approved that he's going to give out 15 to 20,000 for first home buyers?
I did hear something about this. I heard it maybe 2 months ago or so, and I haven't heard anything about it since. And so I think what the goal is he's trying to promote first-time home buying. And so there's some dollar amount, it might be 15,000 that he wants to, so you have to close on a loan. And then I think there's some type of agreement to live there for a year or two or something like that. But then you get 15,000 back as either a tax credit or something like that. But I don't think it's passed, and I don't think the details have been flushed out yet.
Mm-hmm. Okay, thank you. And the second question is, so if, let's say I lease a car versus purchase the car, what's the difference would be for the approval? Which one is better, basically?
From my experience,
Mm-hmm.
from my experience, I don't think there is a difference so much. You got to remember, the underwriter is going to look at the file, and they're going to want, the only thing they're really going to be concerned with is what that monthly obligation is. So that whether you own the car or you're leasing the car, that doesn't matter. They're just going to look at the monthly payment, and that's going to go into your debt to income ratio.
Okay. And for any consultation, let's say, should I go to that, the lady, Lisa? Yeah.
Yeah, you can email me directly and I can get you in touch with them. You can email Lisa directly or Sharon, either one of the names that I put up there before, and I can pass those along to Lisa as well. I'll email you their contact information just in case anybody wants. And we do it all the time, where we sit down and we just look at the picture and we give advice on whether, do you need to save for another 6 months, or are you ready, or in your situation, what product may be better to consider? And there's really no obligation there. So.
Okay, great. I will email you. Thank you.
Thank you.
So somebody else has a question. Griselda has her hand up though. Go ahead, Griselda.
Thank you. I just want to say that I agree with Vivian. It is very scary to look at those numbers and wonder if you're going to be able to afford paying your monthly mortgage. But in my situation, I don't give up. So, you know, if I have to find a way to bring more income, I try to focus on that. And for now, what I was advised to do, because I did ask questions with a friend that has her own realtor, and I did ask questions. So he said that to focus on raising my credit and maybe saving money for when the time comes. It's that a good way of starting, maybe to eventually you know, be out there and shop for a home. I just want to be guided like the right way. Maybe not right now, I'm not ready to buy a home, but I'm really working hard and focusing on bringing that credit score up and saving money for eventually buying a home.
Absolutely. I would second that, because remember the slide that I just showed you with the credit scores, right? So over that 30-year period, it cost that individual $75,000 or over that in just interest alone over 30 years. So I would absolutely say raise their credit score as much as you can. And then, like I said, the emergency fund, get those in place, and then look at the different options that you have for the down payment, right? Whether that's just saving funds directly, possibly doing a 401k loan. There's some grant assistance sometimes for first-time buyers as well, which I know we'll be talking about later, Lisa, I'm sure. And lots of things are coming to Burbank. Let's just put it that way.
And that's one thing that I learned new today about grants. So that was exciting to hear.
Yes. And then, you know, family and friends can contribute as well.
I believe Lisa Niarco also has a question. Lisa?
Yes, hi, good afternoon. This is Lisa. So I do have a question. Unfortunately, I had to get back in the car, but I'm here. I wanted to ask, kind of piggybacking off of the last question regarding credit, because I don't necessarily have any credit. I don't have bad credit, but I don't have any credit. I do have a car that I recently purchased, and so I guess that is helping build my credit. I'm not sure how that works, but I just wanted to know if there was any suggestions on how to build credit when you don't have any debt or credit.
So there's a couple of things to address building credit. I don't know if you have a credit card or you believe in using credit cards. Some people just don't like to have those, but you can always do what's called a secured credit card at your financial institution where you front the money. Otherwise, just go apply for a low limit at a financial institution. It's good that you have actually purchased the car and put that trade line, as they call it, on your credit report. There's also some other items you can do for debt consolidation or things like that to help build credit. But just making your payment on time to your utilities, your cell phone provider, things like that sometimes go on your credit as well. So I would encourage you first to pull your credit, right? Because the annual creditreport.com, you can pull it for free and it won't lower your credit. So see what's on there, because there might be one or two more things reporting on there that you don't know about. And then the other thing that's important about credit that some people don't, or they overlook, there's a percentage of your credit score that is based on the different types of trade lines, as they call them. So to maximize that portion of your credit score, they want to see an individual actually handle different types of credit. So like a credit card is considered a revolving line of credit. and an auto loan is an installment loan type of credit. So, and a mortgage would be a different, so they want to see sometimes 2 to 3 different types of credit and see you responsibly using them for 6 months, 12 months, whatever that time frame is. So sometimes if you just have one thing on your credit report, it's not enough. Does that help?
Okay, so I recently received, yeah, that did help. That's good. I recently received a like congratulations letter, and I received a credit card, and they want me to pay $95 a year to have this credit card. So they gave me a limit of $400, but then immediately took away $95. So what is, when you talk about debt to income ratio, how do you want to, like, how do I want to use the card and not use the card to make it benefit me?
Okay, so that, so the debt to income ratio, what that underwriter, at least in the home loan process, is going to do is look at your minimum payment, right? So if you have a $400 limit and you've got a $40 a month payment, let's say it's 10%, they're going to calculate a $40 hit to your debt to income ratio. It's not going to be the total amount. It's not going to be what you can use, anything like that. The one thing I would caution from a credit standpoint, not the home buying, is that you don't want to use over 30%, sometimes up to 40% of the total revolving credit that you have available. So let's say you have 3 credit cards and they're each $1,000 or something like that. So it adds up to $3,000 in a revolving total. You don't want to use more than 40% of it, so $1,200. Because once you go over the 40% or so, it starts hitting your credit score and actually lowering it monthly.
Okay, so that's what I wanted to understand. How can I use a credit card to heighten my credit score versus them lowering it? So you're saying that 40%, use less than 40% every month, and then
yes, and the number one thing you can do is make that payment on time every month. So one trick, they don't really care how much you owe on that credit card monthly. So if you want to take a credit card and just purchase gas once a month and pay it off, and it shows as a paid on time credit card, that's good enough.
Okay.
Also, Lisa, next week we're going to be hosting a financial literacy workshop with Brian Schwartz, and he's actually going to be speaking more about that. So it's basically Get Smart About Credit. So I invite you to join us next Thursday as well at the same time.
Okay, I think, is that done in 20 something? I think I'm.
No, that one's, this is next week because we have weekly workshops. So we also have financial literacy workshops every other Thursday. So we have one coming up next week as well.
Okay,
On
so
the
I would like
13th,
to be signed
right?
up.
Yes, correct.
So I'd like to be signed up for that one.
Yeah, I'll make sure to send you the link. And Brock, Evelyn has a question. She said, would you, you're welcome. She wanted to know, would you recommend paying for a house outright and not having a mortgage?
Would I recommend paying for a house outright and not having a mortgage? Boy, that's a tough one because it depends on your situation. It depends on your age. It depends on how much cash you have lying around. How comfortable are you with the mortgage payment? The other thing is with the mortgage payment, you get a tax write-off. I can't exactly make a great recommendation with that. I would just say there's 2 things you should do. One, you should probably consult your CPA or whoever prepares your taxes because they're going to give you a better perspective on the write-off portion of that and if it's a good idea. And then the second thing I would do is I would search yourself and see how comfortable you are with having a payment or having that debt. Some people just do not like debt, right? They don't like it. They go out and they try to pay cash for their cars and cash for everything. If you're really uncomfortable with debt and you sleep better at night because you paid that house off in cash, maybe that's a good thing for you then. But financially, sometimes getting that tax write-off or not using your cash up front because the opportunity cost of that money, you could do other things with it. Sometimes that's beneficial to people too. So that could go either way. You're muted, Lisa.
Oh, is
I'm
that
still
me?
fairly new with this.
Oh,
So Sarah was asking, how do I become a GAIN member?
How do you become a GAIN member? Well, you can do it online at gainfcu.com. You can actually just apply online and go through there, or you can, I think there's an option on there as well to make an appointment if you'd like to come in and sit down with our staff downstairs. We have a couple of branches. We have one off Magnolia here, and then another one that's in the Pacoima area on Van Nuys Boulevard as well. So you can go to either one of those branches and sit down with the staff there.
And Lisa, I believe she has another question. Your hand is raised.
it is, yes. I forgot to ask this part of the question. I wanted to know, is it such a thing with buying a home to where you can actually have a co-signer if you feel like your credit hasn't reached, where it needs to reach to be able to avoid those extra finance charges?
Yes, you can have a co-signer on a home loan, just like you can on an auto loan or any other loan. Absolutely.
Yeah, okay. Thank you.
Any other questions? All right, so I guess that concludes tonight's workshop. I thank you all for joining us tonight. I really do appreciate your guys' time. And if you guys are interested for next week's workshop, I'll send you guys the link, or if you guys, just want to sign up for it, just email me as well. And if you haven't sent me your full name that you registered under for this workshop tonight, please send it in the chat right now. Okay?
And Lisa, I'll be back on the 20th, correct?
Yes,
For the budget
yes, correct.
presentation?
So
Okay.
the 20th will be budgeting and debt management. Okay?
And if you
Thank
come
you,
to
guys.
both, you get entered into a drawing, right?
An opportunity drawing, and 2 lucky winners will get selected to get $100 off their rent for the month of June. All right.
Right.
So make sure you guys come by.
All right.
All right. Thank you, guys.
Thank you.
Thank you so much.
Thank you. Have a wonderful night.
You too.
You too.
Bye.